IFRS 8 Operating Segments establishes the principles for reporting financial information about different business activities and geographical areas within an entity. The standard was introduced to improve transparency and help users evaluate the nature, financial effects, risks, and returns associated with different components of an organization. Segment reporting is particularly important for large diversified entities operating across multiple industries, products, or regions because consolidated financial statements alone may not provide sufficient detail regarding performance variations within the business. IFRS 8 adopts a management approach, meaning operating segments are identified based on internal reports reviewed by the chief operating decision-maker. This approach ensures that external reporting reflects how management evaluates and manages organizational performance internally. Segment information is highly useful because it enables investors, analysts, and stakeholders to understand which parts of a business generate profits, consume resources, or expose the entity to specific risks. Through segment disclosures, users can assess revenue trends, profitability, growth opportunities, and geographic dependencies more effectively. Segment reporting improves predictive value because different operating areas may perform differently under changing economic conditions. Investors often rely on segment data to evaluate management performance, diversification strategies, and future cash flow potential. In multinational or diversified corporations, segment disclosures help identify high-performing divisions and areas experiencing operational difficulties. Consequently, IFRS 8 enhances transparency and supports more informed economic decision-making within international financial reporting and capital market environments. Despite its usefulness, segment reporting also presents several practical and conceptual challenges. One concern is that disclosure of detailed segment information may reveal commercially sensitive information to competitors, potentially affecting strategic advantages. Another issue involves inconsistency because the management approach allows entities flexibility in defining segments based on internal reporting structures. This can reduce comparability between entities operating within similar industries. Allocation of shared costs, assets, and liabilities among segments may also involve subjective judgment, potentially affecting segment profitability measurements. Additionally, management could manipulate segment structures or aggregation to present performance more favorably. These challenges require careful application of IFRS 8 to balance transparency with commercial confidentiality and maintain reliability and usefulness of disclosed segment information. An operating segment is defined under IFRS 8 as a component of an entity that engages in business activities from which it may earn revenues and incur expenses, whose operating results are regularly reviewed by the chief operating decision-maker, and for which discrete financial information is available. Operating segments may exist even if they have not yet generated revenues, such as startup divisions or expansion projects. The chief operating decision-maker may be an individual or group responsible for allocating resources and assessing performance. Identification of operating segments depends heavily on the entity's internal organizational structure and management reporting systems. This management-based approach ensures that segment disclosures align closely with operational and strategic decision-making processes. IFRS 8 requires entities to identify reportable segments by applying quantitative thresholds and aggregation criteria. An operating segment becomes reportable if its reported revenue, profit or loss, or assets equal or exceed 10% of the combined totals of all operating segments. Additionally, if the total external revenue of reported segments is less than 75% of the entity's total external revenue, additional segments must be disclosed until the threshold is reached. Segments with similar economic characteristics may be aggregated if they share similar products, services, production processes, customer types, distribution methods, and regulatory environments. These rules ensure that segment disclosures provide meaningful and sufficiently comprehensive information regarding the entity's major operational activities and financial performance. Overall, IFRS 8 provides a structured framework for identifying and disclosing operating segments within financial statements using a management-oriented approach. By requiring entities to report segment information based on internal decision-making structures, the standard enhances relevance and helps users understand organizational performance more effectively. Segment reporting improves transparency regarding profitability, resource allocation, and exposure to economic risks across different business activities and geographical regions. At the same time, IFRS 8 acknowledges practical challenges involving comparability, cost allocation, and commercial sensitivity. For DipFRS candidates, understanding IFRS 8 is essential because segment disclosures play an important role in investment analysis, corporate governance, performance evaluation, and strategic decision-making within increasingly diversified and multinational business environments governed by IFRS accounting standards.